Weeds, I want you to really ask yourself, are you trading with the institutions or are you their liquidity? It's a make or break question. Because in the financial markets, if you don't know where the liquidity is, well, you probably are the liquidity. It's the high stakes reality of retail trading, and wrapping your head around this literally changes everything. So here is our roadmap for this explainer. First, we'll cover the smart money paradigm. Then we'll decode the optimal trade entry itself, look at institutional trading zones, walk through a step-by-step practical execution guide, and finally wrap up with some advanced trading perspectives.
All right, let's jump right into section 1, the smart money paradigm, following the footprints.
You gotta think of institutional market makers like invisible giants. You can't see them directly, but their massive size leaves deep, unmistakable footprints all over the charts. Now, on one side, we have traditional retail logic. This relies on lagging indicators, diagonal trend lines, and these totally random static support and resistance lines. It's kind of like trying to predict the future by staring in the rearview mirror. But on the flip side, we have institutional logic. In this paradigm, price delivery is treated as a highly engineered process. It's driven by what's conceptually modeled as the interbank price delivery algorithm, which is basically just a fancy way of describing a computer program designed to intentionally seek out volume and exploit market imbalances. So what exactly are these liquidity pools are targeting? Put simply, a liquidity pool is a huge concentration of retail stop-loss orders. And here is the painful truth about that. Institutions intentionally target these areas to execute their massive positions. They literally need your stop-loss orders to buy or sell without causing massive price slippage against themselves. So your standard retail stop-loss, that's the liquidity fuel smart money absolutely needs to enter the market.
Moving on to section 2, decoding optimal trade entry, the institutional coordinate.
This brings us right to optimal trade entry, or OTE, a framework created by Michael J. Huddleston to decode these specific algorithmic moves. So what is it? Well, it's a precise visual spatial coordinate on a chart. Using a modified Fibonacci retracement tool, it highlights a very specific zone, right between 62% and 79% of a market swing. Listen, this isn't just a random indicator or some blind signal telling you to buy or sell. It's a structural location, the actual where smart money historically steps in for high probability entries. Let's break down the exact mathematical Fibonacci parameters you're going to need to configure on your own charts. At the top, 0.500 is your equilibrium, the absolute midpoint. Then we step into the actual OTE zone. 0.620 is your first boundary, the shallowest entry threshold. Down at 0.790 is your deepest extreme. But look right there in the middle, 0.705, that is the precise OTE. It's widely considered the ultimate sweet spot for institutional re-entries because it offers just incredible risk-to-reward ratios.
And you know, the logic behind this is actually incredibly straightforward. You buy at a deep discount, and you sell at a deep premium. The 50% equilibrium line essentially divides the market range in half. If you're looking to buy, you want to be deep in the discount zone, well below that 50% mark. If you want to sell, you need to be way up in the premium zone, well above 50%. The OTE zone ensures you're doing exactly that and doing it with absolute mathematical precision.
Okay, let's head into section 3, institutional trading zones layering confluence. Now, as powerful as OTE is, you cannot trade it blindly. It absolutely needs structural context. And this brings us to premium and discount arrays, or PD arrays for short. These are the specific institutional footprints we were talking about earlier. We're looking at things like order blocks, fair value gaps, which by the way are basically sudden rushes of momentum that leave literal gaps in price, breaker blocks, mitigation blocks, and liquidity voids. Think about it like this. If the OTE zone is the correct address for your trade, then an order block or a fair value gap resting inside that zone, that's the front door. You need both to actually enter the house. I absolutely love this quote right here because it just perfectly nails the relationship. OTE without a usable entry model is waiting, and order block without OTE is guessing. Aligning that 62% to 79% Fibonacci zone directly with a fair value gap or an order block, that creates the ultimate high probability setup. It's the perfect overlap of location and institutional intent. All right, section 4, practical execution guide, the step-by-step playbook. Let's walk through the actual chronological life cycle of a trade. Step 1, you absolutely must identify your macro bias and look for strong displacement on a higher time frame, like the 1-hour chart. Step 2, Once you drop down to a setup time frame, let's say the 15-minute, draw your Fibonacci from the low to the high of the current dealing range. Step 3, patience. You wait for the price to retrace into that 62% to 79% OTE zone. Seriously, do not chase it. Step 4, confirm the reaction. You want to see the price interact with a fair value gap or order block inside that zone on a lower time frame. And finally, step 5, execute, making sure to place your stop loss safely beyond the origin of the swing so you invalidate the setup if you happen to be wrong.
And hey, just a quick reminder on this absolutely crucial number, 0.705. Entering precisely at this sweet spot, right inside a fair value gap, is the real secret sauce of this entire model. It's exactly what allows for incredibly tight stop losses and massive asymmetric risk-to-reward ratios. You're risking a little to potentially make a whole lot. Now for Section 5, Advanced Trading Perspectives, where we learn that timing is everything. So we've established where to trade, but advanced smart money tracking requires us to understand that when you trade is just as crucial. Not all hours of the day are created equal, right? The methodology identifies specific windows known as kill zones. Why kill zones? Because this is when institutional volume floods the market like sharks feeding. The London Open Kill Zone kicks off around 2 a.m. Eastern Standard Time, and the New York Open Kill Zone begins around 8 a.m. Eastern. Trading exclusively during these specific windows ensures you're aligning your entries with peak volatility. Taking an OTE setup outside of these times, that drastically lowers its probability. This brings us to one of the most fascinating concepts in this whole framework. The power of 3. Just compare the typical retail routine of chasing random breakouts to the institutional power of 3. Institutions quietly accumulate positions, often during the much quieter Asian session. Then they engineer a manipulation phase. This is a false breakout designed specifically to sweep retail stop losses in the wrong direction. But once that liquidity is grabbed, the real move begins. That's the distribution phase, which perfectly aligns with our kill zone OTE entry. Before we wrap this up, I want to share a rapid-fire advanced tip with you, the TGIF Friday liquidity model. Because a lot of traders close their positions ahead of the weekend, Fridays actually have their own unique algorithmic profile. Advanced traders will look for end-of-week reversals where price pulls back into the established weekly range. You anchor your Fibonacci tool to the current week's high and low, and surprisingly, you target the 0.20 and 0.30 retracement levels for quick profits, all while keeping a close eye on the 1.272 and 1.618 expansion levels for deep liquidity sweeps. It's a completely different, really cool way to look at the close of the week. So what's the big takeaway from all of this? OTE isn't just a Fibonacci level. It is the exact coordinate where patience meets institutional intent. By waiting for the market to come to your precise zone, layered with institutional arrays, during specific times of the day, you finally stop being the liquidity and start tracking the footprints of the smart money. The next time you look at a chart, I want you to ask yourself, whose orders are really moving this price? Thank you so much for joining me on this explainer. Keep learning, keep analyzing, and I'll catch you next time.